Hey guys, Breezy CPA here, your certified public accountant, back with another video. In this video, we're going to be taking a look at how accountants and lawyers are fighting back against Trump's SALT cap, which is the state and local income tax cap that was introduced by Trump in the Tax Cuts and Jobs Act. So accountants and lawyers team up to fight against Trump's tax provision, which is what's written in this article here. Professional service groups say that they are unfairly targeted in the Republicans' big, beautiful bill. So basically, this relates to the state and local taxes and the cap that is being placed on certain firms and partnerships as far as how much you can deduct on a yearly basis for your state and local taxes. So back in 2017, Trump introduced the Tax Cuts and Jobs Act. And among the controversial issues with that act was the SALT cap. So this is the state and local taxes. And before 2017, you were allowed to deduct all of the income and property taxes that you paid to the state and local governments from your federal taxes. But under the SALT cap, that changed and it was capped at $10,000. So if you paid $25,000 in state and property taxes, you were only allowed to deduct $10,000 of that. And what happened was, in order to combat this, the states allowed certain pass-through entities and businesses to deduct a portion of their taxes at a business level as opposed to the personal level. So 36 states introduced a solution where businesses like partnerships or S corporations, they could pay the state taxes at the business level instead of the personal level. So this meant that firms could deduct those taxes as a business expense on their federal returns, and then they'd pass along that clean income to the individual partners, thus lowering the partners' overall tax burden. So who does this SALT tax apply to? So only those that are specified under service trades or businesses, SSTBs, would be excluded from using this SALT workaround. So the workaround that the states allowed, basically deducting that expense from the business as opposed to passing it on to the individual, basically, it affects accountants, lawyers, doctors, dentists, consultants, veterinarians, financial advisors. However, it does exclude others, such as architects or real estates or engineers, from this workaround. So basically, it's picking and choosing who it's allowing to use the workaround and who it doesn't allow to use this workaround. So basically, the workaround only applies to businesses that can elect to pay state taxes at the entity level, so partnerships or S corporations. Sole proprietors typically file as individuals on a Schedule C, so that would not be a pass-through entity. So the workaround wouldn't apply to a sole proprietor. However, sole proprietors accountants that operate under an LLC or an S corp, they would be allowed to use this workaround. So, yes, this could lose the benefit if you fall under a professional service category under an LLC or a S corp or partnership. So, let's say that you're an accountant in California and you're earning $400,000 a year and you currently deduct $40,000 in state taxes through the entity level workaround. Without the workaround, you are limited to the $10,000 SALT deduction and your federal income tax would go up by 30,000 or more, and that would lead to thousands in additional federal tax liability. So low to mid income earners under 150,000 in low tax states may not notice a huge difference in the amount of taxes that they have to pay, but higher earners in partnerships or S corporations in higher tax states will be most affected. So if you live in a state like Texas, for instance, where there's no income tax and you earn $120,000 a year, you won't be affected because no SALT is deducted deducted, and you would not be using the state workaround anyway. However, if you live in California and you're making $500,000 a year, you can currently deduct 50,000 of your state tax at the entity level, and you would lose that deduction, and you would pay an additional $14,000 in taxes. So, looking at this article here, accountants and lawyers team up to fight Trump tax provisions. Professional service groups say that they are unfairly targeted in Republicans' big, beautiful bill. The so called SALT cap limits the ability of individuals to deduct state and local tax payments from their income before calculating their federal tax liability. U.S. accountants and lawyers are mounting a furious lobbying effort on Capitol Hill to head off a tax rise targeted at professional service firms, which is buried in Trump's big, beautiful bill. The giant tax and spending package lawmakers are negotiating will shut down a tactic firms used to cut a partner's federal income tax. So that is the workaround that we just talked about. The American Bar Association this week wrote to senators calling the measure fundamentally unfair for singling out professional service firms, which include doctors, dentists, veterinarians, as well as lawyers and accountants and consultants. The AICPA, the American Institute of Certified Public Accountants, called the measure ugly and has coordinated accounting groups from across 53 states and territories to write to senators demanding that these provisions be dropped. So at stake is a workaround that the U.S. states introduced after the first Trump administration limited the ability to deduct state taxes. So the so-called SALT cap was one of the more contentious measures in Trump's 2017 Tax Cuts and Jobs Act because it disadvantaged people in typically Democratic areas with high state income taxes and local property taxes. The legislation reduced to $10,000 the total state and local taxes that taxpayers could deduct from their returns. And it proved particularly uncomfortable for homeowners in well-off areas such as New York and California, as well as highly paid lawyers and accountants, because of the profits of the partnership were passed through to the partners and taxed as individual income. The workaround introduced in 36 states allows the state income taxes to be paid at the firm level, but House Republicans proposed barring its use by professional service firms. So basically, they're saying here that it's a targeted effort and it's ugly, they say here, the AICPA. It's complicated and it's buried in there. Somebody else says we were aware of it first and faster. Top Senate Republicans have indicated they intend to scale back the SALT cap, which they say is regressive and costly, but negotiations are continuing within the House. And according to the Tax Foundation analysis, eliminating the workaround for professional service businesses would raise $73 billion over 10 years to partially offset the cost of raising the cap. They say here the move would be fundamentally unfair and widen the tax parity gap between professional service businesses and other pass-through businesses and corporations. Noted here is the vast majority of law firms in America are small pass-through businesses, as more than 75% of practicing lawyers in the nation work as sole proprietors or in small firms. So these professional service businesses provide just as many benefits to the economy and society at large as other pass-through entities and corporations. So taking a look here, let's say that you were an accountant and you were earning $500,000 as a partner in an accounting firm. So if that were the case, then if you were to have an annual income of $500,000 and you lived in New York, then the state income tax would be $50,000, 10%, and you would be capped at you wouldn't be capped. You would be allowed to deduct that full $50,000. So you would only be paying federal tax on $450,000 of income as opposed to $500,000 of income. So that would mean that your federal income tax would be 157,500, and your total taxes for the year would be 207,500. Whereas now, if the workaround were to be eliminated, partner has to pay the $50,000 in state tax personally. So only $10,000 would be deductible for the federal income. So the federal tax would be 490,000. So with the tax, you would be being taxed on 450,000. Now you're being taxed on 490,000. So what does that mean for the taxpayer? Well, at a tax rate of 35%, you would now be paying $171,500 of tax for a total tax paid of $221,500. So that means that before the bill, you would have been paying 207,500, and now after the bill you're paying 221,500. So that's an additional $14,000 of taxes that you would have to pay on that $500,000 a year, because they would be removing this workaround. So that would mean that the effective tax rate for this individual would go from 41.5% to 44.3%. And what you have to think about here is that this is just for a single partner within a firm. So if you think about the thousands of firms across the nation and the tens of thousands of partners within those firms, then that amount would add up to billions in revenue for the federal government. So that is basically what the SALT cap is and what they are trying to implement here. Do you think that this is fair for the SALT cap to be targeting specific firms and partnerships? Or do you think it should apply to everybody? Do you think there should be no SALT cap? Let me know what you guys think about this in the comments down below. Thank you to everyone who subscribed. Make sure to hit the subscribe button if you haven't already. Thanks for watching, and I'll see you guys in the next one.